Welcome back, Mortgage Sensei here. Today, what we want to cover is derogatory credit, and just kind of break down these different types, these different statuses, how they affect you when it comes to your home loan approval, and then what methods and ways you can go about in order to get those removed off of your credit report. So, first things first, um, we also call this DROGs, but at the end of the day, we're talking about derogatory credit. So first, what is a derogatory credit account? Is any account that shows negative activity, okay? Negative activity. The more recent the information, the harder impact that it makes on your credit report. So this can include things like late payments, collections, charge-offs, foreclosures, bankruptcies, the list goes on. But that's what we're talking about specifically when it comes to derogatory credit. Now, why do you want to address these derogatory remarks? The biggest thing is for your loan qualification, okay? Your loan qualification. There may be situations where, and I've worked loans like this before. I'm working with a client and they have a mid 640 or even higher credit score, right? Maybe a 700. But there's derogatory remarks that's reporting on their credit report and they can't get approved. And they're like, well, Nelson, my credit score is a 700. How is this possible I can get qualified off of my credit? Well, it's because you have certain derogatory remarks just on your credit report that a lender, when they look at it, they'll be like, yeah, no, this is a no-go for us. And then it causes challenges. So, when it comes to your preparation stage, before you get in contact with a lender, it's normally best to make sure that your credit is clean as you possibly can get it, ideally within the last 2 years, when it comes to those derogatory remarks. Now, let's talk about how, right? How do I clean up my credit? How do I get rid of these derogatory remarks? Well, the first thing we need to do before we talk about how you can go about getting these remarks removed, we need to really dive deep into, the educating aspect on these derogatory remarks in and of itself. So the first thing I want to do is kind of list out the different type of derogatory remarks in which you can have. First of which is late payments. Late payments, okay? Now, late payments, if you looked at my previous video when it comes to the pie chart, late payments make up, or payment history, make up about 35% of your credit scoring. So, that's up to a little bit over 190 points you can get from just making payments on time. Now, when we're looking at qualifying you for a home loan, right, we're looking at it from a standpoint of ideally what has happened within the last 2 years, or if it's something more severe, what has happened in the last 3 years, right? So within the last 2 to 3 years is ideally what we're looking for when it comes to qualifying you for a home mortgage or a home loan. So when we talk about a late payment, again, giving you an education on this, a late payment is any situation where you're making your monthly payments back to the lender. Let's say your payments are due on the 15th of the month, right? So payment come due July 15th. That's what we're going to, July 15th, right? You want to make your payment before August the 15th. But let's say you make your payments on August the 16th. Well, a full calendar month has rolled, or 30 days, but a full calendar month has rolled, and now you are 30 days late on your monthly payment. The more you have of those late payments within the last 2 years, the greater the impact that it makes on your credit score, right? Also, it could lead to a situation where you can't get qualified at all, regardless of where your credit score is, because of how you manipulate your credit report, especially when you start involving disputed accounts or especially derogatory accounts that's in dispute. I've seen that happen before as well. Or a client has a high 600 credit score, have recent late payments on their credit report. However, they disputed these accounts, so it's not taken into account with their credit score modeling. However, when you're going through the underwriting process, the underwriter is going to look at it and be like, yeah, no, I see what you're doing, and no, you're not qualified. So late payments. The next aspect when we're talking about potentially derogatory remarks is collections. Collections. Now, collections, you have non-medical and you have medical. Okay? You will have non-medical collections and medical collections. Now, when it comes to getting a home loan, right, we do not factor in medical collections on your approval. However, the credit bureaus will adjust or recalculate your credit score in an adverse manner if there are medical collections reported on your credit report. So it doesn't hurt you when it comes to us figuring out, your credit worthiness. However, it does hurt you when it comes to your credit score generated by the credit bureaus. Okay. Now, the next thing is charge-offs. Okay. Charge-offs are situations where the creditor, the lender, is no longer pursuing you for repayment. They've written it off with the IRS, and they closed their books or the process of trying to collect payments from you. However, on the credit report, they reflect it as a charge-off, and that negatively affects your credit score. However, when it comes to obtaining a home loan, we don't take into account charge-off. So the moment we see charge-off, we omit it, we ignore it. It doesn't play a factor into your debt income calculation, but it will affect your credit score in and of itself. The next thing after that will be bankruptcies. Bankruptcies, or we call them BKs. So when we're dealing with bankruptcies, all right, the last 2 years from the application date, the application means you're under contract and the initial disclosures go out. Ideally, within the last 2 years, we don't want to see any kind of bankruptcy, whether it's dismissed or discharged, right? We want a 2-year span from that date. Now, there are situations like with a Chapter 13 bankruptcy where you can be in the midst of the bankruptcy making payments to the bankruptcy. As long as you made on-time payments within the last 12 months, you may qualify for a loan like a FHA. But if you're talking about a Chapter 7, Chapter 11, Chapter 12, those type of bankruptcies, right? Farmers, or business owners, those type of bankruptcies, then we're looking for a 2-year gap span since the bankruptcy was discharged or dismissed, right? So if you started it, you start going through the process. I didn't sign the final paperwork. It was dismissed. It's a reset, right? 2 years. The next thing after that, and now this is more severe, right? Foreclosures. Also would be considered a short sale, a deed in lieu, right? Those are situations in which you had a real property, single family residence, condo, townhouse, you had a real property, right? And you were having difficulties making the monthly payments. And then in a foreclosure situation, right, you miss normally it's up to 6 months. It's normally, depending on the state, each state's different, but right around 6 months of payments have been missed. You've gone completely through the foreclosure process. The sheriff goes out to your home, takes your home away, right? That's a foreclosure. Short sale is a situation in which you may or may not be behind on payments, but more than likely you are behind on payments, right? And the home, you're trying to offload it, right? Work something out with the lender. Let's say you owe $400,000 on the mortgage. The home appraises or only is worth $300,000. So there's $100,000 loss. I can't sell the house because I owe too much money on it. You contact the bank, you work something out with the bank. The bank says, you know what, the home is worth 300,000. There's a $400,000 mortgage. We're going to allow you to go ahead and sell a property at 300,000 to release yourself from title, and we will short sell or shorten the balance and write it off. So that's what the short sale means. Deed of lieu, deed of lieu is a situation kind of similar to a short sale, but basically you are in lieu of going into foreclosure, and then you transfer the deed out of your name, or you give the deed away. Normally it goes to the bank or it goes to whatever representing party. But when you're talking about foreclosure, short sales, and deed in lieu, in our world, that is severe to the case. However, from the final date of the transaction, so when the foreclosure is finalized, short sales finalized, deed in lieu finalized, there can be a span of a minimum 3 years, and you can go with a loan program like an FHA. So normally, FHA is normally a saving grace when it comes to having multiple or a lot of derogatory credit within the last 3 years or less. Anything older than that, you may be able to go with a conventional loan, especially if it's over 4 years. Maybe some lenders may say 5 or 6, but if it's over 4 years, you can possibly go with a conventional loan, which is ideal in most situations. Now, when it comes to another aspect of dealing with credit, okay, this is not specific to the credit report. I know I talk about it often. You may have heard me say it in other videos or in some of my book that I wrote or in my workbook that I put together, talking about the Cavers report, the Cavers. Well, the Cavers report is a report that is pulled to check out all of the court systems in America, right? And what we're looking for is any kind of liens, judgments, encumbrances, any kind of defaults, delinquencies that's against you that may not be reporting on the credit report, but that was filed through the court system against you, right? So that's what a Cavers report is. Now, a Cavers report normally brings up things having to do with the IRS. We'll see that often, right? You know, you owe the IRS some money. You know, they put a lien or a judgment against you, right? And it's not showing up on your credit report, but we're going through the process, and the Cavers report is pulled on you, or the title company pulls one on you, and then boom, the IRS debt pops up, and now we have to address it, right? Also, what we'll see is federal liens, right? Federal liens, a common one will be student loans. Now, there are situations where a student loan is not reporting to your credit report. I've personally dealt with this situation before. We pulled credit, nothing was on credit report. I was like, okay, great. We're moving fast through the process. She want to go on a contract immediately. She goes on a contract. We're going through the process, and a Cavers report is action to be pulled on her. Mind you, your loan originator, they cannot pull a Cavers report, right? So we as loan originators, we normally don't have the ability to catch that up front. It is left to the underwriter to pull a Cavers report, and not all underwriters pull it immediately at pre-approval, especially if the loan program states that no Cavers report is needed, and then something changes. Maybe credit score goes down and it's triggered, you know, stuff like that happens, especially if it's over a course of time. But long story short, a federal lien popped up, and it had to do with student loan. Student loan was delinquent, or in this case was in default, and it was a very large amount. We're talking about close to $100,000. So of course, you know, we ran into a hard situation. We had ways of getting out of it. They didn't want to play ball, so unfortunately we had to cancel out the contract. But these are situations in which we have to be on the lookout for. Another thing is um, state debt. So we got federal liens, we got state liens. State liens can be anything far as like state income taxes, right? That's a quick and easy one right there. But it's anything that's through to the state or anything that's filed by the state government through the court system against you, and it populates on a CAVERS report. State liens normally will include child support. Let me put that there. Child support, right? So if you're in a situation where you know you're supposed to be making your child support payments and it's not being reported to your credit report, and you think you're going to get one over on the lender because it's not showing up on credit report, and you know you haven't found your child, you haven't paid any of your child support, just know it'll pop up on a CAVERS report, especially if it's action. Now, the way to get around not being actioned on a CAVERS report, have as high as a credit score as you possibly can. Go with a program where it actions and states that, oh, you don't need a CAVERS report. But normally that comes into play when your credit score is super, super high and the lender follows the guidelines to the T and don't have any kind of lender overlays. So that's a quick breakdown of the different derogatory credits that you have or could have. Now, over in this bottom section here, we're going to talk about ways in which you can get rid of derogatory credit off your credit report, but still maintain high credit, okay? Now, if you haven't watched my previous video in regards to credit and the way I broke down credit, please stop the video, go watch that first, and then come back and watch this, because when you watch this, it'll make more sense as I talk through how you can utilize the rules in your favor, right? There's nothing wrong with bending the rule. There's a problem with breaking the rule, right? So when we're talking about derogatory credit, the first thing we got to understand, again, is the makeup of credit. What do I need to have on my credit report in order to make up strong credit? Okay. My recommendation is always to have at least 3 accounts. You want to at least 3 accounts that has been reporting on your credit report for at least 12 months or a full calendar year. That's all in good standing. If you have at least 3 accounts that are on your credit report, then you can go about satisfying debts, removing stuff off of your credit report in order to eliminate the bad or the derogatory, the stuff that's weighing down your credit, and give more weight or more lift to the items on credit that is reporting good or great on your credit. And then you'll see like a swing effect, right? You'll see your credit score probably go down a little bit because you closed some accounts, and then you'll see it start to go up, right? So let me explain the situation. So again, you have 3 accounts reporting on credit. You're making those payments on time. You've been doing so for the last 12 to 24 months or longer, right? Of those 3 accounts, you always want to ideally have at least 2 revolving accounts. If you have more than 2 revolving accounts, great. If you have more than 2 installment loans, great, right? But what I'm saying is, out of the 3 accounts, you want to have at least 2 accounts that are revolving, or at least always have 2 accounts that's revolving. You may not have any installment loan accounts, but you have multiple revolving loan accounts. That's fine. But you want to have at least a minimum 3 open credit accounts, and make sure at least 2 of the open credit accounts are revolving accounts. Okay, we have that understanding. You follow the plan that I explained in the previous video, and now we're addressing this derogatory information. What can we do in order to get rid of it? So we're going to go down each and every one, and we're going to talk about it. So first thing, let's talk about late payments, right? Now, when you're dealing with late payments, and you're talking about removing late payments off of your credit report, it is almost impossible to remove late payments on an account that you are currently making payments on. So if you're making payments on an active open account, and you go to the creditor talking about, hey, remove these late payments off of my credit report, more than likely they're not going to do it. They're going to leave it on your credit report. So how do you go about removing late payments off of your credit report? Well, the first thing is satisfy the account. If you can, if you have the money to go in and pay the debt off and satisfy the account, then satisfy the account, then get it with a credit specialist and remove that derogatory reporting off of your credit report or those late payments. So one option is pay and close account. All right, that's first step. And then second step is remove account from credit. Okay. Now, the reason why we want to pay, close, then remove is that if we simply remove and ignore it, a collection company, because that's their whole business model, will go out there, buy the bad debt, and report it to your credit report. And then you got to start the cycle all over again. So if you pay the account to zero, close the account for maybe revolving accounts. Again, you always want to make sure you have at least 3 accounts open in good standing, right? But maybe close the account and then contact a credit specialist that you work with. I have a phenomenal one for whoever that works with me. I'll get you in contact with them. They work some serious magic. But you'll get in contact with the credit specialist, credit repair company, right? And they'll go about removing the account from credit. It's easier to remove accounts that are closed instead of removing accounts that are open, right? Now, there are ways you can remove accounts that are open if you really, really know the law, or the credit company really, really knows some law and can draft a well-qualified type of letter to get them pulled off. But even if you get them pulled off, again, it's just a matter of time before another collection company goes out there, buys the debt, and put it back on your credit report. All right. Now, let's talk about collections. Okay, collections. All right. Now, when you're dealing with collections, okay, when it comes to medical collections, I normally advise my clients not to address medical collections, especially if you're over that magic 640 plus number, right? If you're over that 640 plus number and you have medical collections, I normally will say don't even worry about it, unless you just want to make your credit pristine, perfect, right? Now, of course, the higher your credit, the more advantages you get with your interest rate and possible pricing. Pricing meaning how much lender credit I can get, or how low of a rate I can go down without having to pay discount points. The higher the credit score, the better. But in my personal opinion of just getting home ownership, because you can always refinance at a later date once you own the home, but getting home ownership, 640 is always the number. I'm gonna state in and out. Now, when you're dealing with non-medical collections, right? The same could be true if the accumulative number, so how much non-medical collections, if I add up everything on your credit report that is a non-medical collection, right? If that number exceeds, so X is greater than or equal to $2,000, right? We want to start addressing it. The reason being is that once you get to $2,000 or more in non-medical collections for every loan program except VA is a little bit different, then we start to make up a monthly payment or a 5% multiplier. So in this scenario, $2,000, right, multiplied by 5%, do the math, right? You start to add up that monthly payment quickly, because 5% is a lot. Now, for those that's considering a VA loan, right? The VA will look at your non-medical collections, and if the reporting, the way the collection company reports it on your credit report, if they report it as a monthly payment, then that monthly payment is what we use to qualify you for a loan. So the VA could potentially force you to pay off and satisfy those collections depending on how they report it to your credit report. For more information and make sure you understanding it and reading it right, please get with a mortgage professional that really knows VA loans. That way they properly take care of you. All right, now dealing with charge-offs, okay? Charge-offs are, again, we don't factor that into your debt to income ratio. It doesn't matter how much or how many charge-off accounts you have. And normally what I tell my clients is this: if you have charge-off accounts and you're over a 640 credit score, don't worry about it, right? We can get you into a house. Now, again, if you want to make your credit pristine, perfect, right? Then when it comes to charge-off accounts, you want to treat it kind of similar to collections and late payments, meaning you want to pay the balance. So you want to always try to negotiate, see if you can get it paid at a discounted amount, right? Or close for less of the balance. Maybe you get 20% off, 30, 40, 50, 70, whatever percent. That's between you and the creditor. There's no magic number. It's just whatever you can work out. But pay the account, close the account, get with a credit specialist, and remove the account. You can do that for late payments, collections, charge-offs, right? Get them all up. When it comes to bankruptcies, right? In most cases, you gotta wait the allotted time when it comes to a bankruptcy. However, there may be a credit company out there that has some strong understanding of the credit system or the credit laws, and they can go about getting it removed off of your credit report. And no, that normally does not show up on your CAVERS report. So if you are working with a credit specialist that knows how to get a bankruptcy off of your credit report, then great, right? But in my experience, it's normally super hard to get that report removed off of your credit report. Same thing for the foreclosures, right? If you got an account that's in foreclosure status, right? You normally got to work the allotted time. Like I said, minimum 3 years in most cases, maybe longer, depending on the lender that you're working with. But you can get with a credit specialist that really knows what they're doing and get that removed off the credit report as well. Then you don't have to wait as long. Now, when you're dealing with the CAVERS report, again, this section here has more to do with the CAVERS, CAVIRS, CAVERS report. Now, when you're dealing with a CAVERS report, I'm gonna put it down here, right? There is only two options, only, right? There's no getting with a credit specialist unless they're just top tier, right? But there's normally no getting with a credit specialist that can go in and remove stuff off a CAVERS report. So in order to address a CAVERS report, your first option is to pay and satisfy the account, right? Meaning that whatever the balance that you have, you contact them, always see if you can negotiate for a lesser amount, pay that amount in full, settle, right? Let's say it's a large number. In this case, like especially when you're dealing with IRS, the compound interest aspect. But let's say it's a large number, right? Student loans, whatever, right? Well, your secondary option is to set up a repayment plan and make 3 months payments on time, and it is consecutive months. So no, you can't call them up today and make a lump sum payment of 3 months and expect that's going to work. It doesn't work like that. You got to call them up and then set up a payment arrangement, make 1 month, 2 months, 3 months payments on time, and then whatever your monthly payment is will need to be factored into your debt to income ratio, and then you will be able to qualify for whatever you qualify for, right? It probably eat into how much it is, but that's a way for you to get qualified. Now, that applies to pretty much everything that's on the CAVERS report, but understand this. Normally, the CAVERS report comes out after you go on the contract. That's the normal process. So after you go on the contract, the CAVERS report is pulled by the underwriter. Again, the loan originator can't pull it. We can make a request, but the underwriter is not obligated to pull the CAVERS report, right? Because it's a process, and it's more upfront cost that the underwriter has, the lender has to take. But the CAVERS report is pulled, and then when they see that, They're normally going to tell you you need to pay it and satisfy it, or you get it released, meaning that we can confirm that the debt is illegitimate, or it was already satisfied, or there's an error or something like that. But if it's legitimate debt, then most of the time you're paying and satisfying that count before or normally at closing, or you will have to cancel the loan, cancel the contract, call them up, set up a repayment plan, make 3 monthly payments on time, then restart the process and continue to make your monthly payments. Continue to make your monthly payment. Don't call them up, set up 3 months payment, make 3 months of payment, and then just stop making payments and think you're gonna get it done. You have to show financial responsibility from application through funding. So through the point you have the keys in your hand, you have to show financial and credit responsibility. This is your mortgage sensei. Hopefully this is a lot of great information that we dropped here for you. I pray that it does wonders for those out there that's watching it. If you would, please, if you enjoyed this video, like, subscribe, hit the little bell, share this with your friends and family, loved ones. Check the description. There's some information linked towards my book, linked towards how to obtain my guide in regards to how to get a home with a loan, all of my social sites. Please also leave a comment here. The more comments, the better. Hey, Nelson, I like this. Hey, Nelson, explain more of this. Hey, Nelson, this is my situation. This channel here is meant to teach. It's always the big three with me. I'm here to educate you, empower you, encourage you, because everyone deserves home ownership. If they want it, you deserve home ownership. And we're going to talk about what you need to do in order to get prepared and to get final approved and get your keys. This is a Mortgage Sensei here, and I'll see you on the other side of home ownership.